Welcome to Study Session 7, Liabilities of Auditors. Introduction. You know now that auditors' reports are relied upon by users of financial statements. In this lecture, we shall examine the extent to which auditors are liable in case users incur any loss from relying on the audited accounts. Objectives. At the end of this lecture, you should understand the situation under which users of the audited financial statement can make auditors liable. Companies Act offenses. It is an offense under the Companies Act to accept an appointment as an auditor when disqualified to do so, or to continue as an auditor after becoming ineligible. Conspire with others to carry on a company with intent to defraud. Knowingly or recklessly to cause an audit report to include any matter that is misleading, false, or deceptive in any material particular. Knowingly or recklessly cause an audit report to omit a statement that is required under certain sections of the Act. These are statements that company accounts do not agree with accounting records and returns, statements that necessary information and explanations not obtained, or statements that directors wrongly took advantage of exemption from obligation to prepare group accounts. Fraud offenses. It is an offense to commit fraud by making a false representation, that is, written or verbal statement, dishonestly knowing it was false or misleading, with the intention of making a gain, causing a loss for another, or exposing them to risks of a loss. Failing to disclose information when under a legal duty to do so. Dishonestly intending to make a gain or cause a loss. Abuse of position when in position where there is a duty to safeguard and not to act against the financial interest of another person, dishonestly with an intent to make a gain or cause a loss. The abuse may arise from an omission as well as a deliberate act. To be found guilty of fraud in any of the three ways, the behavior in question must be dishonest, and there must be an intention either to gain from the dishonest action or to cause loss or risk of loss to another. Duty of care. Duty of care is the obligation to exercise a level of care as is reasonable in all the circumstances in carrying out professional work. In the case of an audit, for example, to minimize the risk of material errors or misstatements being included in the financial statements. This would require auditors to exercise the level of skill, care, and competence expected of a suitably qualified professional in the circumstances. Note that this duty of care does not require any form of superhuman effort, nor does it require any particular foresight other than a reasonable consideration of the possible consequences of actions carried out. The duty of care is therefore based upon the relationship of the parties, the negligent act or omission, and the reasonable probability of foreseeing any loss. Only a negligent act will be regarded as having breached a duty of care. Negligence. Negligence can be defined as an act or omission which occurs because the person concerned, for example an auditor, failed to exercise that degree of reasonable skill and care which is reasonably to be expected in the circumstances of the case. For an allegation of negligence to succeed, the claimant must prove that the defendant had a duty of care to the claimant. There was a breach of the duty care. The claimant suffered actionable harm or damage. The damage was caused by the breach. There are two situations under the civil law where auditors can be sued for negligence. Under contract law, where a contractual relationship exists, and to a third party where a duty of care exists but is not contractual. Letter of engagement duly signed by the auditors and the client represents the basis of a contract between them. Because there's a contract, the auditors can be sued for a breach of it if they don't provide an audit report or provide a negligently prepared audit report. The reason for this is that the existence of the contract creates a duty of care between the auditors and the shareholders to whom they report. Although the letter of engagement is signed by the directors, they are signing it on behalf of the company which is owned by the shareholders. So the duty of care is owed to the company, not to the directors. If the auditors fail to carry out their duties, they can be liable. London and General Bank, 1895. The court held that the auditor's business is to ascertain and state the true financial position of the company at the time of the audit, and his duty is confined to that. This raises the question: how is he to ascertain such position? The answer is by examining the books of the company. But he does not discharge his duty by doing this without inquiry and without taking the trouble to see that the books and records of the company show the company's true position. He must take reasonable care to ascertain what they do. Thomas Gerard and Sons, 1968. For many years, the managing director of the company falsified the inventory figures in the accounts in order to conceal losses and to enable dividends to be paid. To do this, he included non-existent stock, and he also altered invoices which were discovered by the auditors but not followed up or investigated. The auditors relied on stock certificates given to them by the managing director, a person who they trusted. They contended that it was not part of the auditor's role to take stock, merely to verify the figures, and that they were entitled to rely on the assurance given by the responsible official of the company. This was supported by the decision in the Kingston Cotton Mill case, where the judge stated that an auditor is justified in believing tried servants of the company in whom confidence is placed by the company. However, in this case, the court held that the discovery of the altered invoices had put the auditors on inquiry, and they should have investigated the matter. They were no longer able to trust the assurances given to them and should have made inquiries, if necessary, from suppliers to verify the assurances given. Once the auditors' suspicions were roused, they had to investigate the matter fully. If they had done so, the fraud would have been revealed. They were thus guilty of negligent auditing. This is particularly relevant where auditors are obtaining information from officials of the company without a concomitant amount of corroborative checking work. If they have reason to doubt or are suspicious of any transactions, they must follow it up. This is supported by the content of ISA 240, which requires auditors to follow up on queries and anomalies. Candler vs. Crane, Christmas and Co., 1951. In this case, Candler sued the accountants, Crane Christmas, of a company as he had relied on the accounts they had prepared for the purposes of making a decision to invest money in that company. The accounts turned out to have been negligently prepared. The court ruled that although the accountants had acted negligently, they did not have a contract with Candler and therefore did not owe him a duty of care. This ruling was taken by the accountancy profession as meaning that no duty of care was owed to third parties. J.E.B. Fasteners vs. Max Bloom, 1980. The audited accounts of the company did not show a true and fair view of the state of affairs, and the auditors were held to be negligent in stating that they did. At the time, it was accepted that the auditors were aware of the plaintiff's interest in the company, but not that they were contemplating a takeover bid. The courts held in favor of the auditors, as the plaintiffs had not suffered a loss and would have brought the share capital at the agreed price, whatever the accounts had said. The duty of care issue was, therefore, irrelevant and was not considered by the court. What makes this case important, however, is that the court stated that a duty of care will exist where the auditors knew or reasonably should have foreseen at the time that the accounts were audited that a person might rely on those accounts for a particular purpose, and that in all the circumstances it would be reasonable for such reliance to be placed on those accounts for that particular purpose. This case raised the possibility that an auditor might owe a duty of care to a third party who reads the accounts and then makes an investment or some other decision after relying on those accounts. Effectively, after this decision, the auditor might owe a duty of care to an unknown person. ADT Limited versus BDO Binder Hamlin, 1995. Assurances had been given to ADT by the auditors of Britannia Security Group. BDO Binder Hamil BBH. ADT asked them if they stood by their audit opinion, and they replied that they did. This created a relationship between ADT and BBH, who knew that ADT were looking to buy Britannia. After ADT had bought Britannia, they discovered that its assets were overstated by £65 million. The court held that by confirming its audit opinion to ADT, BBH had created a contractual relationship and were liable for damages and costs totaling £105 million. Peach Publishing Company versus Slater and Co., 1997. In this case, the auditor gave an oral assurance to the reliability of some unaudited management accounts which the purchaser relied on when buying a business. The judge said that an accountant does not automatically assume liability, and that in any case, the purchaser should have made his own checks rather than try and obtain some form of warranty where none was intended. This case does, however, highlight the danger of third parties trying to obtain some form of assurance from the auditors, and care has to be taken in statements made to them, especially where there may be a possibility of that third party placing a reliance on the assurances given. The general principle of liability to a third party, where the auditors know that the audit is going to be relied on as some form of assurance, is reflected intentionally. Agreeing the duties and responsibilities in an engagement letter. This should specify the specific tasks to be undertaken and exclude specifically those that are not to be undertaken. It should also define the responsibilities to be undertaken by the client and specify any limitations on the work to be carried out. Defining in their audit report the precise work undertaken, the work not undertaken, and any limitations to the work. This is so that any third party will have knowledge of the responsibility accepted by the auditors for the work done. Stating in the engagement letter the purpose for which the report has been prepared, and the client may not use it for any other purpose. By identifying the authorized recipients of reports in the engagement letter and in the report. By limiting or excluding liability by a term in the engagement letter or to third parties by a disclaimer in the report. By obtaining an indemnity from the client or third party. By defining the scope of professional competence to include only matters within the accountant's competence. Summary. Although financial statements are assertions made by management and are primarily responsibility of management, it is the accountant's duty to provide assurance of these assertions for the users of the information. As the liability of auditors to third parties increases, auditors will be forced to more carefully perform their work and look for additional means of reducing their liability. However, if accountants are not held to a high standard, their incentives to carry out their job will be reduced. If someone is not held accountable for these erroneous financial statements, users of the financial statement cannot rely on the content any longer. This is the end of Studies Session 7. Thank you.